Okay, ladies and gents, come in, come in. We are perfect timing. The market is just a little shudder. The equity market, as US equity markets, little shudder just as I started the webinar. Let's see where she closes today. Of course, we've got Fed coming, FOMC coming up tomorrow. Shenanigans until then. Chris Weston, actually, if you're following Pepperstone on Twitter, Chris Weston posted a really excellent video explaining some of the potential outcomes of the Fed if they do a 25 basis point cut, the 50 basis point cut, the language and all that type of stuff. So that's worth kind of looking at and maybe working out your game plan for the different scenarios. There are multiple different permutations that we could have. This isn't a webinar about that at all, but just using that type of thing, someone who's an expert in that field, and then kind of folding it into your trading plan, your strategy, your area of expertise, which is potentially chart patterns or momentum or mean reversion, whatever you're going to play. And I think just maybe it's okay to sit out during Fed. That's fine. But I also think sometimes just coming up with different ideas, like, hey, if we suddenly push in this direction hard, we reverse, will I take a break to the high side? That type of thing. So we'll get started in a moment, guys. Give a couple more minutes so I can waffle on a little bit more about Fed ideas. And maybe that's something we can cover at some point in the webinars. I've got a few coming up over the next few weeks. Got the election coming up. Definitely going to do an election webinar talking about ideas and ways to potentially trade the election, either on the night or on the other kind of news flow that goes up, starts to flow, should I say, as we're coming up to the vote itself. But for a big number like or a really high impact headline like this Fed meeting, I think it just the simple way to approach it is to think of different ways, things that could happen with price. So the market you like to trade, I think spreading yourself too thin is dangerous. If you're trying to watch gold, you're trying to watch cable, you're trying to watch NASDAQ, you're trying to watch rates, I think that's dangerous. I think you focus on one market that you're a specialist in and say, right, here's my idea. If we kind of fall to the downside and then we start to rip back up, maybe I'll look to trade that. If we fall to the downside and we kind of do a lot of work to the downside and then we start to reverse at the end of the day, will I look for that? This type of thing. Will I wait until the press conference? Just these different ideas and thoughts. Will I wait for a trend to kick into gear? And if it's an obvious trend, will I buy a first pullback from that? Will I look to take a flight? There's all these different ideas and thoughts. And I think just being prepared and saying, hey, this is what I'd like to see to trade that is it's a good way of operating. It's a good way of operating rather than flying by the seat of your pants. Oh, it's Fed, something bound to happen. I'm going to, got to get involved with it. I think just careful and prudent planning, or even stepping aside and going, what, I'm going to trade tomorrow. I'm going to wait till the next day. If something crazy happens and interesting from a price action perspective, day two follow through or day two flush and reverse will set up. Anyway, today, ladies and gents, I want to get started and talk about mastering the art of trade review. But before I do, this, if I see myself, yes, you can see that. Good. This is a real old school book. This one is called Studies in Tape Reading by Wyckoff, actually. He calls himself Rolo Tape here. And here's an interesting little extract I want to mention to you. The study of responses is one of the most valuable in the tape reader's education. It is an almost unerring guide of the technical position of the market. Of course, all responses are not clearly defined. It is a matter of indifference to the tape reader as to who or what produces these tests or critical periods. And then he goes on to say, so to translate that, this is when we talk about responses of the market going through key levels. So when we get flushes through levels that reverse quickly, that's what Wyckoff talked about in when was this? It's got to be 1910, right? The same type of psychology of, hey, what's the price response to something interesting? So if we kind of put that with our Fed idea, hey, this is bullish, whatever the bullish thing may be, price has responded in a negative manner. Oh, it was to sell the news event. Or if we look at it from a pure technical perspective, that's a key level from yesterday's low print. Price goes down, looks underneath it. What's the price response? It's an immediate sell-off, capitulation style, flagging at lows. Okay, the response is this selling. From a tape reader's perspective, we know who's in charge. So thinking about how price responds to different levels, and if you peel in catalysts with that, like the FOMC, then that can really give you an idea of the underlying price action. And I've done a webinar on that exclusively before. We've talked about and a price action, and we talked about that type of thing. So go and check that out. It's on Pepstone's YouTube channel. But I think as a trader, you're a technical trader. North Star of, okay, tape reading, it's not just about reading the depth of the market. And in fact, it was never about that in the beginning. That's kind of evolved over time. But it's about understanding how price reacts to certain levels and reading the psychology of the market through the price, speed, response, and all that other type of stuff. Okay, so let's get to it, ladies and gents. Today we're talking about mastering the art of trade review. First of all, I must please remind you that spread betting CFDs, very risky. You're trading with leverage and you know how leverage works. I hope you do. If you don't, please have a double check what you're doing, how you're getting involved with this. Very, very good when it's working well because you're amplifying your gains, but also can work against you. You're amplifying your losses. So you have a losing trade, which all traders do. That's going to be amplified much, much more. The fact you're using leverage. Pros and cons. Just understand the game you're playing and understand the risks you're taking, and just really know, what you're doing, and be really, really, really kind of firm about how much you're prepared to risk and how much you're prepared to trade with. Okay, so what gets measured gets managed. Peter Drucker, very, very good quote from that gentleman. Of course, that's what we're trying to do today. So today I want to cover really is this as sexy as some other stuff? No, it's not. But often this is the thing that moves the needle the most, right? We've done strategies, and I'll more than likely share different strategies as well as we move forward with these. Loads of others in the archives, different strategies, VWAP, opening range breakout, this type of stuff. Fine, they're cool, they're headline stuff, that's great. But the way to get better at trading is to make incremental improvements and just keep adjusting your heading very, very slightly. However, if you move the needle too much or the heading too much, you end up going around in circles. If you don't do it at all, you end up paddling, burning a lot of energy. And all you've done is you've done a big, big loop. You can imagine a ship in the ocean, the heading's just off, he's burning fuel and he's going round and round and round, and actually he's done just a big loop and back to where he was. And some traders are like that. Been trading many, many years. They've got a lot of experience. They've burnt a lot of fuel, a lot of energy, a lot of effort, and actually haven't got very far. They've got a reasonable journey and reasonable time of screen time. They haven't got very far. And I think that this is really the thing that helps you put those two together. So the fuel and energy you're using to drive forward in the experience, but also just keep just tapping yourself on the right heading. Okay, so let's get straight to it, ladies and gents. Just a quick reminder, even though I have been trading for a couple of decades, I don't have all the answers, and I would never claim to. My ego is not big enough. The market has removed any ego from me. I will share with you my key ideas and thoughts and things that I think work well. And I run Traders Mastermind, which I get to see, and I get to see other traders, so other traders who have kind of just tipped over the line into profitability, had a couple of good years, traders who are really just struggling. And so I get to observe not only my own trading experience, but I get to see others as well. So I think I'm quite well placed to help you out. And I say this kind of every week as a point of view of, hey, just take away what you think is valuable from this and go and do your own analysis and research. I feel like I have got some good things to share and I'm well placed to present those to you. However, it's up to you to kind of do that and go away and kind of dig around and say, hey, is this any good? It's going to work for me. Does it suit my personality style, et cetera, et cetera. So that's that. Okay, let's go in. So today we're going to cover a two-part trade review process. And why two parts, you might say? You might say, Mark, why two parts? Because I think that having two gives you two different focus points and goals. Number one, you do a daily debrief, I call it, which is like a report card. Some people call it a daily report card, and that reviews your daily performance, right? And number two, you do one a week in focus process to assess your weekly performance. I'm going to dig into those, and hopefully by the end of this webinar, you are going to say, okay, I like that idea. It's not going to take me too long. I'm not going to give you reams and reams of stuff you have to do. I'm not going to say, hey, you got to spend hours and hours doing this. It's short, it's simple, and it should be effective enough to help you improve your trading based on what you're already doing. Because that's the benefit of doing a trade review process, right? It's trades you've already taken. It's not hypothetical setups. It's not stuff you might do in the future. It's not, I must do this, I must do that. It's stuff you have already done. And now you're just making minor adjustments to try and improve stuff. Okay, so why do we create two different processes for review? So the daily report card or daily performance review is really to, I mean, you know what it's like, right? You trade in the day. You feel like sometimes you've had 12 rounds in Mike Tyson. You're like, geez, you know, it's a real battle. That I feel like I had a green day, but I really, really earned that. But the next day comes and you forget all about that day. So the important thing to do is to conduct a daily review whilst it's still fresh in your mind, because part of the thing is going to be what were you thinking? Why did you come up with that idea? And when you go back to it at the end of the week and you look at, well, what happened on Monday morning? Why did you take that DAX trade? Or why were you shorting cable there? You're like, I can't even remember, to be honest. I don't even know what I was thinking at that point in time. So that's important why we do this daily report card. And then the week in focus review is really you're looking at the persistent themes that occur throughout the week. So it's a broader perspective, and I kind of show you some of the ideas and tactics to do that. And then you make the little tiny adjustment, maybe in your plan, or maybe in your focus, or maybe in your methodology for next week, so that as a short-term trader, as an active trader, you're responding to the dynamic nature of the markets rather than looking at your performance at the end of the month. It's too late to make the changes. You might be doing something very you're out of sync. You're out of sync. You're a bit early on the day, or a bit early for trades. You're a bit late on the flush trades. You're chasing stuff, whatever it might be. And you know this is a game of seconds sometimes. Depends on what time frame we're trading, of course, but it's a game of a couple of candles sometimes, right? Depending on the time frame we're trading. So that's why we do it in this cadence. The daily report, while it's still fresh in your mind, to extract that valuable information whilst it's still there. And the week in focus is kind of looking at a big overview and saying, right, do I need to make some course corrections to get me to the next station, the next level? What do I need to tweak and adjust? That might not be anything, but most of the time you just need a little adjustment. And that might be operational from a kind of trading perspective. It might be psychological. It might be any of these type of things. Okay, so let's talk about a daily debrief. And by the way, if you've got any questions, I don't think I mentioned it, you're very welcome to ask them in the Q&A section. I will get to them at the end. Last week, we were running quick. I had a lot of slides and I was plowing through it. This week, we will have time to answer the questions, so I can slow down a little bit, because I know that I haven't got thousands and thousands of slides to cover, because when I'm doing this, I just want to cram so much information in, but I forget sometimes that we have a limited amount of time together. I wish we're back again next week anyway with a different topic, but for this week, I can take some time. Okay, daily debrief. So after you've had that trading day, we're going to audit the performance, okay? And we want to look at our trade performance, so our P&L. We want to look at the best trades, the worst trades, an assessment of our trading psychology. So what's our mindset? What are we thinking? As we know, that's such an important, critical element in our trading. What was good? What needs work? Pretty simple, but actually this is where you kind of find the little patterns over time. Here's a daily performance review that we use for our Traders and Traders Mastermind. Top, date, P&L, grade that you've given yourself out of 5. So you can do whatever you want here. This is an idea you can kind of come up with your own. Number of trades you took on the day, your focus area, your best trade, your worst trade. So what was good, what wasn't so good, and then performance analysis. What did you do well today? What needs improvement? What can you take from today to improve tomorrow? Simple stuff, because the last thing you want to do at the end of the trading day is sit there and write reams and reams of stuff. Now, if it's you and you're quite happy doing that, you're quite happy, doing all that stuff, that's fine. But sometimes you're really fatigued. You don't want to do that. You want to do something simple, and you want to do something the same format each time. So at the end of the week, you can look at these sheets and go, right, now I've got an idea of these 5 trading days, what's gone on, what my grade was, how that relates to my P&L, what was the best, what was the worst, etc. Okay, so one thing to mention here is the objective isn't to make any massive changes to your plan, right? And that's important. I want to kind of pause on that. That's why I've put this in a separate slide here, is we want to just audit and measure. We're not making changes based on one day. That's a very dangerous game to play. We've probably all fallen into that trap. Oh, maybe I widened my stop because I got pinged out, and it went my way. No. Okay, we want to see a pattern of performance and a pattern of habits and a pattern before we make changes. There is an argument also to suggest that actually sometimes weekly changes might be too frequent. And that's fine if you say, Mark, you know what? I trade a little bit of a higher time frame, I want to do it every month, then I wouldn't say no. I'd say, listen, you would just adjust and understand that there's two different levels of analysis. One is that regular frequent analysis. And if you're a higher time frame trader, maybe that's weekly. And then there's that infrequent objective assessment, and that might be monthly for you. So just adjust it based on the time frame you're trading, right? Okay, so the next part of the daily review, I consider to be separate. Now, a lot of people kind of bundle this all in the same thing, right? And they say, okay, you do this and do that. But I think that you've got two aspects here. You've got one is your performance, and number two is the market's performance. They're two very different things. And I honestly believe, and I see this time and time again, and thinking back to kind of late 2000s, I would always muddle this up, always muddle it up, and it's two distinct things. So one is how are you trading, and the other is what's the market doing. And very often when we're looking at the market and we're looking at the price action and we're watching a chart, whatever vehicle you trade and market you trade, we are so caught up in trying to trade that we actually miss some patterns that are repeatable and have edge. I send out a daily email, and one of the daily emails that I send out this week is, I've sent out this week is talking about just observing patterns. Last week we had this V-shaped reversals on NASDAQ kind of 3 days in a row, very unusual. And the point was that you can be prepared for the next one when you are really focused on seeing stuff. And very often when you have the burden and pressure of performance on your shoulders as a trader, you don't actually see the patterns. I know it sounds weird, but you might feel this as well. You're kind of looking to trade, you're focused on taking this trade, you're trying to buy this trade, you're trying to do this, trying to do that. You don't actually get to see and review. So this is a very, very important step. Very important to mark up your charts, and you put your actual trades on the charts. But this is the key part. You make notes on any price observations and any potential improvements to your execution. But you do this from a perspective of, hey, I'm looking at it through the lens of complete objectiveness, objectiveness. I made that one for you. Objectivity. And you just have this complete focus of, hey, how could I perform better? What has the market done? What could I have reasonably seen in the heat of the moment that is going to help me? Now, we'll talk about hindsight bias in a second, but here's an example from one of the traders who won't mind me sharing it, keep anonymous anyway, but example what he would do, right? He puts little markers on and says stuff like flat overnight, pulling back to the pre-market, little observations, right? Oh, it's punched up through here, it's retested here, the VWAP's there, blah blah. And this is just something you'll do every day or throughout his trading session. Just making observations, right? Another one here from a trader, won't mind sharing this. Again, I'll tell you who it is, but marking his trades on, putting the little annotations, close at breaking, took a profit this high, yesterday's high. So just marking up your charts. This is such an important process. And here's a little hint for you. When you're doing this, as I said, look through an objective lens, right? It's easy to fall into the trap of, oh, I got to bought that high. I would have bought that high. I'd have sold the high, and I would have bought the low with size. And yes, you got to be realistic. And sometimes just moving your chart up to the hard right and kind of reviewing as you go through, there's playback functions on trading views, playback functions if you want to do that way. Or what I like to do is print it off or screenshot, put onto an iPad or tablet and just mark it up like that. I think that just being able to look at it and say, okay, and we're going to run through one together in a second, what happened? What really happened? What could I look for next time? What's valuable information here? What's not so valuable information here? And I think, just being able to print off a chart and just getting away from the screens, just looking at things through a different perspective, that I guess that's the key of this, right? And I'm not a psychologist, but I think that that's why this is so effective, is that you are saying, okay, trading day's done. Let me print off the chart. Let me look at it. And because you're now looking on a piece of paper or you're looking on a tablet or you're in a different environment, you get to see things that you wouldn't do before. And this is how you create new strategies for yourself. The amount of strategies that I've developed, I've just been looking at a chart and going, I didn't even see that. It's happened the last 4 days. What am I doing? Right. Now I see, okay, I'm ready for it day 5 or ready for it day 3. And it might be a little edge. It might just be a little kind of momentum ignition at the top of the hour, bottom of the hour, reversal at a certain time. I might develop a strategy that works for several months off it. that type of stuff. So there's just something about changing that perspective. And obviously, you don't have to do it this way, but if you're going to do it, I think it's a very good way of doing things. So let's run through one together, right? I printed this off, well, was it half an hour? No, three quarters of an hour ago. Actually, you just had a big sell off after that. Then, well, it was the DAX, but there you go. So imagine it's the DAX. Imagine this DAX. This is the DAX. Imagine you're done for the trading day and you're reviewing the chart. So let's look through this briefly together and give you an idea of what maybe you'd look at. Okay, so I've marked down the open and I marked down the close. It's 24-hour product, of course, with Pepperstone, but I want to just look at the cash session. So I might mark down stuff like, hey, look, for the first hour, we didn't really do a lot. We kind of had these wicks, we had these tails, not much was happening, and we had a gap up from the prior day. I'd already done my context assessment, by the way, and that's a separate thing, separate kind of issue. But just looking at the chart you're trading, we have been trading, and saying, okay, we had a bit of a fake to the downside that came back up to the opening print. We were sitting around there, and it wasn't till 10 o'clock that we actually started to break out, form an uptrend. So I might mark down on that 10 o'clock breakout. Was there anything that kind of was a precursor for that? Yeah, maybe the dip below the low first that was fell. When we talked about in this book, Studies in Tape Reading, what's the response? Well, the early dip, in the first hour or so was bought, and actually that might have indicated that I would be interested in trading a breakout to the high side. And there was a little breakout pullback type trade there. Okay, fine. You've got to be careful. You're not saying, oh, I definitely would have done that, but you're just noting down clues. So you then take that and say, false break, precursor to potential breakout to highs. We're in uptrend already, reasonable bullish environment. Okay, maybe that's good to go. Maybe that would be good to go next time. So tomorrow, would I look for the same thing? And then you kind of start to kind of build this reference point. And then you might say, okay, we had a bit of an uptrend here. There wasn't really much opportunity to buy a pullback. We were stretched away from the VWAP. We kind of had this little double top here. Some people call it tweezer, right? Tweezer, something like that. And then we roll back over. We didn't really get a pullback to here. Oh, how could I have grabbed on that? Would I have kind of sold this engulfing here, or this outside bar, should I say, here? And you just start to observe, and you can kind of look and you go, well, it wasn't really reversal signal. It happened to be the top, but we didn't really have another attempt back up. Okay, so maybe this wouldn't have been here. But the VWAP, look at this. The VWAP coincided with this kind of cluster of support here. Okay, so next time after we've extended away from the VWAP quite heavily, maybe I'll look to buy the VWAP. And that ignition candle kind of looked like it was a reasonable momentum ignition. Okay, fine. We had this kind of flat top resistance here, broke out, failed. You might then say, oh, we had a fake out and it was just before the US Open, roll back over, wanted to be at VWAP for about the US Open. So you're just analyzing. I'm not going to go through every little intricate thing, but you see the point. You're going through the day and you're just observing. And you're not suggesting, oh, I would have sold the high and I definitely would have taken that. You're just making an observation. You're just saying, hey, listen, on a rotational day where we've pushed the highs, tested VWAP, if we're sitting back at highs and we've got 30 minutes until the US Open, and we see, and maybe you see this pattern time and again, that actually it starts to roll back and sit at VWAP for the US Open, then guess what? You're going to be ready for that the next trading day. I'm not saying things repeat all the time, but just this process, and how long will that take us together? Three minutes or something, and maybe you take 5 minutes doing it. But just the process of going through that chart review, as well as what trades you took, I think is the perfect scenario at the end of the trading day. Okay, so that's your daily review. Daily review is your performance. And if we go back, I'll just show you this again. I'm sure people will ask what this was. So this is something you can just come up with, right? Your P&L, your grade, your number of trades, your focus area, best trade, worst trade, what did you do well, what needs improvement, etc. Good questions to ask yourself, okay? And you're marking up your chart as a secondary process. Now you've done your daily review. Done for the day. Shut the screens off. Go into something else. You're ready for tomorrow. We should do your pre-market prep before the open. But one of the things you'll do in your pre-market prep is you start to look at, hey, what happened yesterday? And you've got it there ready. You've reviewed it. Things are fresh in your mind. And you remember things as well. You might say, oh, do you know what? At that point in time, there was a little bit of news came out. And there was a bit of a rumor coming of this and that. And I started to see things on this. Or at that point in time, gold broke to high, whatever it might be. There's some things you remember when you're heat at the moment that you wouldn't do normally. So this is a great time to do that review. Okay, there's your daily. Let's talk about now the weekly. So how would you do this? How would you kind of look at this? And a reminder, You've got your daily process, which is those two things, and you've got your weekly process. And I like to have those distinctly separate because they mean a separate thing to me. So the weekly review process is slightly deeper. Conduct it after market close on Friday. So over the weekend, Sunday evening is a great time. Many traders sitting down on Sunday evening, preparing for the trading week. Your objective here is to gather all those daily reports and then make any adjustments needed to your trading plan. Okay, so how do we do that? So gather all those daily report cards. And what you're looking for now is commonalities or themes. And something I talk about very, very often here is there's often clues in your trading. There's often stuff and clues in your trading that you can adjust and change. Or should I say this? Often is a better way of phrasing this. There are clues in your trading that tell you should be doing something different. So are you constantly going a little bit early on those exhaustion trades? Are you constantly a little bit late on those extension trades or momentum trades? Those are the clues that you see. Hey, look at those 5 trades. 3 of those are a little bit chasey. I got away with that because X, Y, Z, blah, blah. You start looking for that. That's a very easy, low-hanging fruit win for you. Because what you can do is you can say, hey, on these momentum plays, they're good. They tend to work out okay, but I could probably just look at that. If I looked at all these, especially last week, if I just waited 5 minutes, I would have got a better fill. Okay, so maybe that's something I put down and something to consider as an adjustment to my trading plan. And this is the thing that you look for. You look for, oh, look, I'm really good at spotting that. I could do some work with this. I take too many trades really on these type of days. I'm hesitating to pull the trigger here. And going through those report cards, you start to see what your real problem is. Because the trouble we have with traders is we look at our P&L, especially for developing trading, you're like, not quite where I want it to be, right? It's not really where I want it to be at the moment. And you start thinking, oh, what's going wrong? And you start mulling in your mind, I'm not doing this, I'm not doing that. When in reality, it's probably one big thing that needs fixing. And by conducting the daily report, that'll be highlighted. You'll immediately go after you look at the daily reports. Look, man, I'm taking too many trades. I'm holding losers too long. I'm not holding winners long enough. I'm giving back too much P&L on, when I'm up on the day, whatever it might be. And this is why you have these daily reports. You can go through and you can look for the commonalities or themes, the positives and the negatives, and then adjust, right? And then adjust. So if we've looked at these, right, we look at our daily report cards and we say to ourselves, all right, first things first, give yourself a pat on the back. We don't do that as traders. We are almost like, no, you shouldn't be doing this. No, you should stick to your rules. No, hold the trade. Bad boy. That's no good. And of course, we need to push ourselves to improve and put things in place operationally to help us improve. More on that in a moment. But give yourself a pat on the back. This is why I say, what did you do well? It's important to say that. It's important, and I'm not going to scroll back to that daily report performance review, but it's important to put down stuff you did well. Small things, because there were studies done that if you're constantly berating yourself and constantly beating yourself up for not doing the thing you want to do and not giving yourself a reward, then eventually your brain just goes, well, sod it. I'm not even going to bother trying because I get no hit from it. I get no dopamine hit from it whatsoever. I get no recognition. And you know what it's like, right? If you're doing something, maybe you're at school or maybe you had a job or whatever it might be, you do something, you get no recognition. It doesn't feel good. Human beings don't like that. So we're the same internally as traders, right? And if you're working in a trading team, then someone would come and say, hey, you know what? You're really good at catching those lows there. Hey, you know what? You're really good at kind of holding trades when you get on the end of it. Now, you might be weak in other aspects, but that is the thing you hold on to and go, yeah, okay, I can get better at that. So always give yourself a pat on the back for things you're doing well. I think that's very, very important. And I know the type of trader you are. Generally speaking, the people who get involved in trading are ambitious, are driven, want to succeed and move forward, but we can be slave drivers sometimes. So then you analyze where you want to improve and you come up with a potential solution. And this is where you must be solution focused. So, example, you find you closed a lot of trades in too early last week. So you write down the challenge, and rather than just saying to yourself, well, don't close the trades too early, you come up with a solution. This is the missing piece of the puzzle for so many traders for improvement. We can come up with the problems easy enough. I don't do this. I don't do this. I don't do this. I don't do this. That's easy. But the next step is missing from traders because often they do is they say, I don't do this, or I do this, bad habit. Answer, don't do bad habit. And you might be saying, yep, that's me. That's me. That was me for ages. Like, oh, I'm breaking my rules on this. Don't break rules. Simple. Don't break rules. You say, well, I'll do that. And then it never works. It never works. It never works. You get frustrated. The better way to do it is to say, hey, I'm doing this. What's a solution, an operational solution I can put in place right now that will over time fix this? Idea here, solution. So if you find you're closing your trades a little bit early, you know what? Rather than saying, well, don't close them early, hold them. Say, okay, well, you know what I'll do is I'll have a couple of targets. I'll take half off of the first target and I'll trail the rest behind a moving average, or I'll trail the rest every 30 minutes. I'll move it up by 50 points, whatever it is, right? You know how you trail stops. But the key here is you have challenge and solution, and being solution focused again is something that is missing from so many traders' playbook. They come up with the problems. I can't do this. I do this, but they just go from there to, well, I'll just fix it. We'll just do this. It's not as easy. You know it. I know it. It's very hard sometimes to change the way our brains are hardwired without taking it a little step at a time. We'll just close half. Just close half. Just try not to overtrade. Try and overtrade a little bit less. It's just that gradual progress. And you know, I love the hint here, and I've mentioned this already in the earlier slide. You know, it's important to just pick one thing at a time, right? It's important to say, hey, you know, you may have a selection of challenges in your trading. Maybe you aren't holding trades. Maybe you're jumping in too early. Maybe you're over trading. Fine. And you may then be legitimate, right? But just pick one thing at a time. And as I mentioned, say, you know, don't just say just do it. Try to find that practical way. So if you go through a daily report, a performance review, you look at your daily report cards and you go, it's a bit of a mess, right? I overtraded here. I chased here. You know, no wonder I'm red on the week. It can feel demoralizing and a bit devastating, like frustrating, and you want to just kind of scrunch them up and go, let's see what happens next week. A better approach, and why you conduct this performance review every day so that you can do it at the end of the week, is to say, well, what's the biggest thing there? You know what? The biggest thing for me is every so often I go over my daily risk limit. Nah, that's dangerous. So how can I stop doing that? Well, just don't do it. Little voice says, well, yeah, I know that, but I'm still doing it. I'm still behaving like that, and I don't want to. So, okay, what should I do? Well, let me try and put a timer in place, and kind of every hour, just double check what my risk limit is. Or let me make sure that I'm trading the small enough size that I'm not actually going to ever overcome my risk limit. Or let me set this, or let me do this. What operationally or practically can you put in place to help you improve that one thing that you're trying to improve? And then next week, you say, that's my focus point. And you can see now how if you did this consistently week after week after week, rather than being that ship that just goes round in a big bloody circle in the ocean, you would be a trader that actually managed to, you go off course a little bit. It happens, man. You know, it's never going to be perfect. But you come back on course. You go, but I fixed that. And then I fixed this. And then I fixed that. And all of a sudden you see land and you go, you know what? Here we go. Things are starting to happen now. Things are starting to happen because you've done the review process, you've done your weekly reviews, and you've looked at it through a practical lens and said, how can I fix this? Solve Forex. We're all entrepreneurs here. We're all trading. This is an entrepreneurial venture doing something that's performance endeavor. Okay, solve Forex. The problem is this. What's the solution? We'll just stop doing it. That's not going to cut it. What's the operations? What's the practicality? What's the actual steps you need to take to get there? That's, I know I'm laboring the point a little bit, but that's such an important aspect of trading. Okay, so now you've done you've looked at all your daily report cards and you've kind of come up with your one idea, you've come up with that commonality in the theme. And let's be honest, sometimes you might go, you know what, that was a damn good week. In which case, marinate in that feel good and say, look, I ran the trade there. That was great. I didn't get caught out there. It was a red day, but I didn't get caught out. I traded to my plan. 5-star here, 4-star here. Damn, that was a good week. And whether it was red or green, you just say, hey, I want to do more of that. And so the adjustment might not be from a negative perspective. It might be a positive impact, a positive influence, should I say. You say, actually, look, this is what I want to do more of. make sure I'm in the right frame of mind here, make sure I'm pushing on the trades that are working well, make sure I am sizing up on the deals that I know that I've got a positive expectancy on, whatever it might be. Okay, so let's go back to your marked up chart. So if we remember, we had that kind of little DAX run through it very, very quickly. And I said, okay, this is kind of how you might mark up your charts. And I do believe it's so easy. It's so much easier to see price action that way. It's so much easier to say, hey, look what happened. We tested that high, we failed. The VWAP was an obvious support. Okay, brilliant. Okay, now I can look for it the next day. So, okay, how do you use that? So one is it helps you kind of debrief and get stuff down on paper, a little bit like a journaling process, right? But subtly different. So what you want to look now is and say, get all your charts for the week, the trades you took and the markets you were trading, and you say, is there something interesting that I can take from this that I might want to look for next week? I.e., very often we're testing lows in the early part of the morning session and we're bidding straight back up to the open. Okay, well, that's something I might want to watch out for next week. Or very often a rotational type day, we're kind of extending and okay, after 6 p.m., if we have an ignition candle on the VWAP, it looks like we push back to VWAP. You start to see things. And your objective as a trader isn't to go and trade the simple textbook stuff that, okay, fine, a double top, a this, a that, or the other. To a certain extent, in the right context, all these things are effective. In the wrong context, it's completely useless. But it's you to say, look, we had this double top, but actually look at the time of day it was. It was in this rotational environment. We'd already done this and tested the low. We were already within the prior day's range. We had some data coming up the next day. That's a very, very high probability trade for me. I can quantify the risk on that trade. Something I could potentially take again if I saw that. You jot it down and you say, right, what's the next thing? Okay, what's the next thing? Do we get a bid? We used to have that noon balloon. We used to have had power hour. We've had all these type of things, right? And these are repeatable patterns that you can only observe if you're looking at the markets through a different lens, and very often you miss if you're trading them and you're just looking at the markets with a view of what trade can I make now? What trade can I make now? You don't see some of the patterns, which is why it's so important to mark up the charts. And then the other thing is, is there a common theme? Like there's a common theme of Linda Raschke talks a lot about this, and she takes this from kind of Wyckoff and I think maybe Taylor. Is there a morning sell-off, an afternoon bid? Is there a theme that's constantly there? Is there an hour or a couple of hours that are constantly strong or constantly weak? Or is a theme throughout the week of, hey, we filled the gap. Most of the times we've filled the gap. Most of the times we've done this. Most of the time we've closed near the highs. Most of the time we've tried to push in the last hour only to come back and close near the VWAP. You get the idea, right? And if you're trading currency pairs, if you're trading DAX, you're trading Dow, it doesn't matter. The same type of theme is there. You might be trading a currency pair and say, hey, listen, we break out of the Asian session for about 30 minutes and come straight back in. And that is something that's happened for the last week. Okay, well, no, guess what? I'm going to look for the same pattern next week. If we break out of that Asian session early in the morning when I'm trading and we start to run out of steam, I start to see a reversal candle, I start to see some sort of engulfing or outside bar, you might take it for a pull back to the Asian session high. You get the idea. It's marking up the charts and looking at things through that completely different lens. And even from this perspective, saying, what's the tape telling me? And the tape being what's price telling me at that point? When it tries to go above a key level and stalls and does this, what's it telling me? It's telling me there is no more demand, or if there is, it's being overshadowed by supply. The supply-demand imbalance is shifting back in the favor of the bears. It could potentially be a short opportunity. Then you bolt in your risk management, then you bolt in all the other stuff that comes in with that. Okay, so once you've done this, and this is your weekly review, by the way, now you can make small adjustments to your trading plan. And as a reminder, your trading plan is your business model, if you like. Like, how am I going to trade? What are my setups? How much am I going to risk? All this type of stuff. I've done, pretty sure I've done a webinar where I've talked exactly about this before, and you can obviously look at that on Pepperstone's YouTube channel or on my website, Traders Mastermind, if you like. So we won't go to too much depth here. But the idea here is you've got your plan of action, how you're trading, you've had your daily reports, you've done your weekly stuff, you've got these ideas. Now you make small adjustments. You never pull big levers and you yank these big levers and go, I'm going to suddenly do this. You do that. You might do that if you find that actually, let's just pause for a second. if you are going to make a big drastic change to your trading plan, do it at a certain point in time in future. Don't do it out of emotion. So if you say, hey, this is not working for me, I'm just screwing up all the time, this is a complete mess, say, okay, I'm going to stick to it till the end of the month. And at the end of the month, if I haven't got the performance I want or the results I want, I will rewrite it. Do it that way as opposed to just doing it, oh man, there's a rubbish week, I'm going to make massive adjustments. Because very often it's the small things that make the biggest changes. So you got your trading plan, you make small adjustments. And these might be, I'm going to look for reversals at a certain time of day. I'm seeing that actually the chart showing me that this 4 o'clock time period, or actually when Europe closes, Dow gets a bid. When Europe closes, Dow starts to sell off, or just before the close, we got whatever it might be. I'm making stuff up. All these things we've happened many times before, but it's the thing you're looking for. It's an operational thing, and that's based on your marked up charts. Okay. And then also in the operational section would be, hey, I want to make sure that I wait just another 30 seconds when I'm putting the trigger on exhaustion plays. Or I want to make sure if I'm buying bull flags that I get a little dip below the low of the flag first before I buy. I want to see that tail before I get in. That's operational. And that again will be based on your performance and marking up your charts with your trades on. You say, hey, look, a bit early on these things. So there's a little adjustments, very small, just tiny little 1 degree heading adjustment, right? Nothing major, just very small things based on the market action and regime you've got in front of you. Because many traders are forcing themselves onto, markets they're forcing their methodology on a market that's not really conducive to it. And sometimes you have to adjust a little bit. And sometimes a great plan has been working very well. It needs a little tweak. It's like, I was buying that bid, but actually that bid's running on for another 15 minutes or so. And I often have to see one more test of the low before I buy it rather than it being exhaustion reverse. So it slightly changes, but you don't see it, but you would do now because you've printed off your charts and marked them up. So you make the operational change. So operational change based on your performance, operational change based on the markup of your charts. That's the first thing. Second, important aspect, of course, the psychological. So is there a theme that after 2 losers in a row, very, very likely the third trade is a loser? Little stats like that are so useful. Like you might even go away now and say, listen, how many times do I have 3 losers in a row after 2? And you'll probably find it's more than 50%. You'll probably find it's something like 70-odd%. In other words, if you've had 2 losers in a row in quick succession, the chance of that third being a loser is very, very high. In which case, you've got a negative expectancy. Well, guess what? You don't do that. After 2 losers in a row, you do something to recalibrate, reset, refresh, go away, have a walk, come back, get ready for the next trade. Because you know that for whatever reason, 2 losers in a row triggers you into frustration. You get a little bit angry. You're not going to start pounding the desk and smashing the screens, I'm sure, but you don't want to be kind of trading from an emotional perspective. There's a psychological adjustment to make. Again, small adjustments. We're not making big, massive things here because I just don't think it ever works unless you're making a concerted effort to say, right, I'm rewriting my trading plan. It sucks. It's no good. This is not suiting me whatsoever. Fine, new chapter. In which case, that's a much bigger process. But I'm talking about these minor adjustments that you can make because very often, you've got something that's sound, right? Your setup is good. Your strategy's pretty good. Your risk management's good, but just it takes one thing in the recipe to be wrong, and it tastes like, it tastes awful, right? It's just like a recipe, a cooking recipe, right? If you've got the wrong ingredient in one wrong ingredient, you've got, I'm trying to think of something on the fly. I'm not a chef. I don't know, garlic in a brownie, let's say, right? Or onion in a brownie. There you go. Onion in a chocolate brownie. I don't need to be going around you to know that ain't not going to taste good. But if you take out that onion, then the brownie's pretty good, right? And brownie's quite nice. Lemon in a, thinking on the fly, omelette, right? Nah, I don't think that's going to be very good. If you take the lemon out, the omelette's pretty nice. That's the same with many people's trading strategies and plans. If the plan's pretty sound, but they're putting an onion in the brownie. They're just putting an onion there, and without the onion, it'd be all right. But you're kind of then trying to think, I'm just not going to do brownies anymore. I'm going to do this. I'm going to do that. I don't know why I've gone down this rabbit hole of cooking, so stick with me. I'm going to do this. I'm going to change that. I'm going to do the other. So I don't know. It's just the onion, mate. Just take the onion out. You'll be right. And so you take the onion out and you cook it. That's not too bad. I might add some more chocolate chips. And then you start making a little adjustments to improve it. But the moment you're like, it's not working, it's horrible. Same with the trading plan, right? You're running the trading plan. It's red, it's red, it's red, it's red. It's horrible. It tastes disgusting. It's not working. Throw the whole thing out. Well, actually, find the problem. Look at the branding, look at the trades, look at the charts and say, where's that damn onion? It's because I'm holding these trades, because I'm taking more trades than I need to on my losing days. That's damaging the plan. It's because I'm a little bit early on this. My stop needs to be wider. That's damaging the plan. That's your onion. That's the thing that needs to be taken out. And from there, you've now got a decent base you can build from. So there's some sort of food for thought, like a pun, food for thought about, how you could really find the challenge in your trading plan. Okay, so what's next for you? So we run through some of the ideas and ways to kind of do a trade review process. It's a challenge for you if you'd like to kind of move this forward yourself. And ultimately, it comes down to you, right? Design your own daily review process. It doesn't have to be fancy. It can be 4 things, 3 things, whatever. It's just something you're going to review. How you mark up your charts, how you analyze your own performance. Simple stuff. What's your week in focus process? So again, super simple. I'm just reviewing my daily review. I'm putting them all together and on my charts, and I'm looking with these intentions. I want to do this, 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 and this. Don't make it a massive ream of stuff. Just like when you're setting trading rules, you don't have 50 rules and try and stick them all. You just commit to doing it, right? And you just say to yourself, hey, you know what? That's what I'm going to do every day. And it's going to take me 2 minutes to do this, and it's going to take me 5 minutes to do my chart, 7 minutes per day. Can I do that to improve my trading? Well, if you can't, you might have to wonder whether this is what you want to do. I'm pretty sure you can carve out 7 minutes. And then a week in focus process. And again, that's 15 minutes, 30 minutes, maybe an hour if you're taking a real time over it and you're sitting there with a coffee on a Sunday morning and you're taking your time, maybe. But you get the idea. It's not hours and hours and hours. And just commit to doing it. 2 weeks. Commit to doing it for 2 weeks. And, that can be challenging, right? That can be tough to do. I get it. Sometimes it's hard to stick with something, which is why, and this is always why having the goal is so important. Remembering what you're doing, right? Remembering that, you're trying to get the information from your own trades to improve. You're trying to say, what's the current price been doing that I can improve my strategy? How can I become the best trader possible by being absolutely dialed in to current conditions and tweak, adjust, adapt? What's the trader I'm becoming? The trader I'm becoming is one who's very adaptable to current conditions. He's an active trader, yes, but he's adaptive. He adjusts. And the same is, from review process. I'm learning all the time. You're improving. You're making a mistake. Do I need to make a course correction? Or is it just a one-off thing? Is something creeping in? Is there a commonality? We talked about that, a thread that's running through my losers that actually I need to watch out for. Is there something positive running through my winners that actually I can put more pressure on? Hey, maybe you're very, very good at trading those breakouts after a catalyst. Okay, great. Does that require more size? Is that something you need to do to adjust your trading plan and say, you know what, I can actually trade less days, but I can allocate the same risk capital on the week to maybe fewer trades, which means bigger size, but actually the risk on the week is the same. You get the idea. And the thing is, if you use this 2-pronged approach, you're going to force yourself forward like a speedboat. You're going to help accelerate yourself forward because you've got 2 engines fueling it. Not only have you got the learning from the actual price action, the market environment, but you've actually got the consistent improvement and learning from your actual trades as well. But again, it only works if you do it. So something here I've got for you. Many of you have this already. That's fine. I didn't develop it at all. I had somebody build this for me. It's a Google Sheet download. It's called the Trader's Discipline Tracker. You're welcome to download it free of charge. And it's a Google Sheet, and you can put in, hey, this is what I'm going to do each day, my daily markup, my daily performance review. And it allows you just to check. That's a cross between a check and a tick, right? It allows you to check it off each day, and you might not be perfect, right? And that's what this is designed for. It's down to say, okay, I can't do it. I've not done it every day, but next week I'm doing a little bit more. Next week I'm doing a little bit more. Next month, do a little. It helps you improve month to month. So this is a very useful tool for that. Okay, I think we've covered everything there. We have got some time for your questions, ladies and gents. If you would like to, I will bring you over here. Okay. How would you distinguish your trade exit? I had a trade earlier today where I exited at the end of my trade daytime in profit, but I had a hunch that it would go to a certain price point, which it did. Do I trust the hunch or keep the habit of cutting my trade in exit time? Um, Hunches don't pay bills. They don't work. Um, Now, why I say that is that what's the best way to approach this, and I say with the best intentions, I'm messing with you. If it's part of your plan, fine. But trading on a whim and trading kind of leaving a lot of decisions up to the last minute, that just doesn't serve you. I don't know how much experience you've got, whether you're a developing trader, whether things are going. I don't know kind of your level, but you need to say to yourself, or if it was me, I'd be saying, okay, hey, this is my trade exit. Um, Today we're in a rotational environment today. Okay, we had a bit of, out of nowhere, a bit of a flush, but generally speaking, pre-FOMC, I'm not going to start being aggressive and looking for like trend days. So I would go into the day saying, actually, I'm just going to take everything out. There's my final target. I'm done. The trade is done. However, saying that, you could add into your plan, I will take out 2/3 of the position or 3/4 of the position at my target, and I will run and trail a third or a quarter. That way, it's not an all or nothing decision you're making. You're just saying, right, 3/4 there, and I will trail and see where the next bit goes. And you might say, hey, I will trail under the low of a 1 minute candle, a 5 minute candle, 15, whatever you trade, or I'll trail under the low of a moving average, or whatever it is. That's one good way of trying to get over the challenge of, hey, it's at my target. But I don't know where it should come out, it shouldn't come out. If your plan says come out, you come out. But if your plan says hold it, you hold it. But a hybrid approach is to say, I'll take out a chunk and I'll run a chunk. Now, the good thing about that is that you are soothing that internal voice that's saying, hold it, don't do hold it. But you're also seeing with data if your hunch is actually accurate. Like you might think, well, today it went my way and my hunch is great. But if that's 1 out of 10, you conveniently forget the other nine, which are human beings, that's not going to serve you. But when you're actually doing this and you're noting down and saying, hey, I held that, and you see it with data, that runner actually only 1 time out of 10 did it go in my favor. The other time, then in which case you don't need to do it. Or you might say, actually, that runner works really, really well. I'm going to incorporate in the trading plan, and I'm actually going to hold half of the position or maybe all the position for a little bit further. Okay. That's a good question. That was Rory's back. He is a regular on the webinars. Good to see you. Thank you for the feedback there. Quick question. When you talk about markup chart at the end of the day, I can definitely say it was helpful when I trade a US session. Since I switched to trade the NASDAQ pre-market during the EU Open for 2 hours, 8 a.m. to 10 a.m. UK, what is your advice to focus on for people that trade pre-market since the EU Open till US Open? What's your question there? When you talk about markup chart, what's your? I'm not quite sure what your question is there, but I'm going to guess. I'm going to make a stab at it. Are you suggesting that? You know what? Here's a question for you. I would say, why are you trading the Nasdaq during 8 a.m. to 10 a.m. when the DAX is probably, and personal opinion here, the better instrument if you're trading the European session? I would say if you're trading that early on, America's not up. The futures are probably just moving based on Europe at that moment. So unless you've got edge watching the kind of European futures, the Euro stocks, the DAX, the FTSE, and trading the NASDAQ from that, I would maybe go, oh, well, is the DAX not a better vehicle from 8 a.m. to 10 a.m.? Maybe it's got a good reason for that, but that was my thinking. Peter says doing reviews daily helps build your discipline muscle. Then that muscle can be used in other areas of your trading. Absolutely correct. And that's the name of the game, right? It's to build that muscle so that you can then sit there in front of the heat of the moment and say, I am going to hold this or I'm not going to trade this. Where can I find a link for the spreadsheet? Oh, yes. Sorry, I should have said that was very, very foolish of me. If you go to Traders Mastermind, tradersmastermind.com, top right, I want to say, and click there, download the discipline tracker. It will open up that page. You can put your email address in it and you'll be sent it straight away. A few questions have been asked about that. Andrew says, with a potential 50 bips on the Fed interest rate on the card, would the NASDAQ gallop in a specific direction? I would think 100 points on 25. Any ideas? What 50? And you know what? Go and Andrew, it's a good question. Go and watch that Chris Weston video, because Chris talks about not just being about the actual the number, but more importantly the language behind it. Because, and I'm not going to repeat what he said, but I think that's very important. Like, maybe there is that impulsive move, but actually, if the language behind it is like, well, Stu did this because of this, this, and this, it will soothe the market. Is like, as potential says, oh, are people desperate? Is it something more? Is it a cause for concern if they're cutting 50? Is it? I think it's not quite as clear as that. And I don't think anyone actually knows so much. I think it's being prepared for the different scenarios. And what you've said is here, I'd think 100 points on this. You may well be right. And maybe it's more on the 50, or maybe it has the opposite effect. But definitely going to watch that Chris Weston video. He is far more in tune with the macro type of stuff than I am, for sure. I'm a price action trader. Anonymous attendee, how do I reduce impulsive trading, especially on slow moving days? That is a good question. You've just got to exercise this discipline muscle. Go and download that discipline tracker, tradersmastermind.com. I want to say /discipline-tracker, but you can find it on there. Super easy. Or you use your own sheet. You don't even have to use that Google sheet. It's there for you. It's free, but you can use your own. But just try to say to yourself, right, how do I know it's a slow moving day first? It's all very odd to say it's a slow moving day after the event, but in the heat of the moment, you're like, oh, I'm just going to trade, right? But actually, a good idea is to say, well, how do I categorize this as a slow moving day? I call them dirty candles, right? Candles are up, down, up, down, up, down, up, down, oscillating around the open. Nothing much is happening. If I look at that and go, this is choppy, then at that point you say to yourself, do you know what? I'm not going to trade today. I'm just going to turn the machine off and walk away. And that's something you just have to do. Peter's often talked about walking his dog. And he was talking about more potentially when he was in a trade, but it's the same thing. You've got to exercise the muscle of discipline that says, in your heart, I should not be trading today. I will do very poorly today. I am not going to trade. And when you've made that decision, Mr. Anonymous or Mrs. Anonymous attendee, you say to yourself, okay, I am done. Donk. The screen is shut. My broker platform is off. I'm going to come back at the end of the day, because you probably know. And what I'm passionate about is I've been there, I've done that. We've all been there and done that. We've had the impulsive trading. We realized we shouldn't have got caught in it. We dug a big hole for ourselves. We look back at the P&L in the month and go, that big red day was because I just traded on some crappy stuff. You just have to get used to doing it and get a win. So when you walk away from the screen one day when it's choppy, give yourself a pat on the back and go, yeah, that's exactly what a good trader does. That's exactly how I want to behave. Giving yourself the win for that and the dopamine hit from that rather than the green P&L. And if you can attach your value and standards as a trader to how you behave under certain conditions, whether that's execution, whether that's taking stops, whether that's running trades, whether that's walking away from markets that you don't do very well on, then you start to see improvements, because you start to say, I walked away and I would have got chopped up to hell on that. So it's just doing it bit by bit. Gary says, I like the run with a quarterable third and trailer approach, hybrid, you say, not all or nothing. Gary, honestly, pal, I think it's a game changer, that, because the internal dialogue is, if I take it, it's going to go further on. If I don't want to give back that unrealized P&L, I wanted to bank that. And you're sitting there, and before you know the market's doing this, you're making a rash decision. It's a simple thing. And then you can adjust over time based on your performance. You go, right, I'm going to bank 3/4 of it. Fine. That pleases that side of the voice. I'm going to run a quarter. He's reasonably happy. Okay. And then over time, I can look at the data and go, actually, I need to run more, because running it, I'm a bit eager with keen with the exit. And that's a really good way of doing it. And then over time, what happened, Gary, is you go, hey, on these plays, I don't even need to think about closing this damn trade. Do not touch it. Do not even think about closing it. The chance of this running to highs are very, very strong. The chance of it closing the days at highs or lows are very, very strong. I've got this thing by the throat now. I'm not going to let it go. And that's kind of a way of looking at it as well. This gentleman says, thanks for the submission, sir. Please elaborate more on how to take half profit while holding the position longer. You just close half your position. So whatever platform you're using, MT4, C-Trader, TradingView, whatever, you can just close half your position. So say you've got, well, I don't know, so what half a position is, right? Whatever your position is, you just halve it and say, as it gets to your key level, let's say you got 4 on, as it gets to key level, you take 2 off, and then you just got 2 left, and you might bring your stop up on 2, or you take 3 off and leave 1 to run. You just kind of chop your position up depending on what you're trading, whether you're trading spread bet or CFD, whatever it might be, and just to take half of the profit off the table, and then look to hold the other position and treat that as a fresh trade. Can you get the recording? Yeah, you can, Paul. Pepperstone will email it to you. Rowie says, I think about the DAX. I notice I am more in focus during the morning since I'm in the EU time zone. So I'm trying to find asset for the morning inside the US afternoon. I'm trying to find asset to trade for the morning inside the US afternoon. Rowie, you say more focus in the morning, then just stick to, do your DAX, man. Just do your DAX. I know you say you're looking for something to trade in the US afternoon. I think that's what you're saying. Then I mean, you could trade the Nasdaq as well, but if you're really focused and you've got energy, then put all your effort into trading the DAX. There's plenty of opportunity there. Andrew says, thanks so much. You're welcome, sir. What is the realistic risk-reward ratio in terms of passing challenges or trading in futures? I'm currently a 1-to-1 ratio, and it's hard to actualize profits. Well, there's a lot more to that question. Let me see if I can give you an overview here. Risk-reward ratio. Okay, let me reframe that. It's not the question you've asked, but let me reframe that for ease of what we're talking about today. So risk order ratio, you've got to, oh God, I've opened a can of worms here. Okay, 2 minutes for this can of worms. Ready? Okay, we've got two scales we can adjust. And it's not the question you asked, but it's the answer you get. You've got the risk order ratio on the trade. So 2-to-1 means you're risking 1 to make 2, so you're risking $100 to make 200, or £100 to make £200, right? We all know, understand that. And then you've got the probability of success. So what I mean by the probability of a win, that's very difficult to quantify because we don't know. But you know, some trades have a much higher expectancy than others just from your screen time experience. Like if you're buying and kind of flush into downside, a high volume, blah, 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 good extension, starts to pause, it's a high probability you're going to get some kind of pop, right? But you might not get 2-to-1. You might get 1-to-1 on that. But the probability of success, you believe, is quite high. So maybe you mark that at 70%, 80%. I'm just making numbers up. Then that works out as a trade, right? It's 1-to-1, but 10 of those trades, 8 of those win, you're going to make money. Okay, then you got the other dial of, okay, you kind of go down the level of success, and maybe you're taking a pullback type of trade, and maybe you give it, I'm making numbers up again, a 60% chance of success, and you go, well, that could reach the high again. I think there's a high chance we hit the high. That's a 2-to-1 risk reward ratio. You gain on your risk reward ratio, but you kind of dial down the probability of success. Okay, because obviously the higher targets you've got, the further target as well. That the further the target is away from your current price, the less likely it is to hit. Okay, so you've got 5-to-1, 6-to-1, 7-to-1s, and then when you wrap it on with the size of the stop, if the stop is very, very tight, it's a high chance of it being hit as well. So you've got to have it stop reasonably wide, and if you're going 2, 3, 4, 5-to-1, that becomes less and less likely. And so the chances of success might go down to maybe 30%. But if you've got 4-to-1 plus 5-to-1, that's okay. So your job as a trader is to work out, where you fit mindset wise. Do you want frequent winners? In which case you ain't going to get 10-to-1 all the time, right? You can't play that game. And so you go, you know what? I want a high win rate, but I'm prepared to kind of go 1-to-1, and that's tough because you're kind of grinding stuff out, and it's a very personal thing of how you choose to do this. Or you say, you know what, I want the occasional 5-to-1, 10-to-1. I'm prepared to lose a lot of the trades or most of the trades to get that big winner. And you kind of adjust those dials depending on the time frame you're trading, the market regime you're trading, and how you like to trade. So based on the question, it depends on what you're doing. If you're doing 1-to-1 and you're finding it hard to kind of get any traction, then your strategy is ineffective, number one, because you obviously don't have that frequency of success, or win rate is not high enough to overcome the 1-to-1 ratio. If your win rate was 80%, 90%, which is a lot, but if it was, then you'd be fine, you'd be okay. But if you're finding that's a problem, your win rate's not good enough, you need to stretch your target. You need to force yourself to look for 2-to-1s, 3-to-1s, more depending on the regime. But we're opening a can of worms. Why I said opening a can of worms here, because it does depend on your strategy. It does depend on where you're taking the trade. It does depend on so many factors. You can't expect to be taking a trade to break out to fresh highs and expecting a full another ATR move on the day. It just ain't going to happen. And so, but if you're taking a reversal off lows back to VWAP, back to maybe fresh highs, then that's maybe worth it. So, long-winded way. Let's put the can of worms back of saying, hey, maybe you could try expanding your risk-reward ratio a little bit. If you're struggling with that, then force yourself to look for 2-to-1s, maybe 3-to-1s. But as long as it matches the structure of the trade you're taking, if you're asking for a lot from the price to go through prior highs, do this and do that to get your target, then the chances are low. But if you say, actually, I've got a good entry here, I can get a 2-to-1 just by going back to the opening print. Let's say you're taking a reversal off the lows. That's a reasonable probability. You're not asking for a massive amount from the market, and you're getting a little bit more from the trade when it goes your way. So that's something to consider. Oh, I've got no more questions. No, I haven't. It's just thanks. Well, thank you very much for your feedback, ladies and gents. I hope you've enjoyed this one. We should be back again next week. What's the topic? Pepperstone will send you a webinar. Anyway, hope you enjoy this one, guys. Take care. Happy FOMCing tomorrow. Bye-bye.